All right, good morning investors, traders, and anyone else watching this video. I wanted to basically make this lesson in this video for those who are inquiring about the exchange traded funds, ETFs. There's been a couple questions that came to my desk or came to me and basically wanted to know what ETFs are, how they can be traded or invested in, and just all around what are they. So here's obviously the questions that I get. What are ETFs? Should I invest in them? And when should I invest in them? Hopefully this lesson will help you better understand when to get in them, start doing your own research and looking at them and considering investing in exchange traded funds, because they can actually bring in some decent returns for those who are passively investing, looking for some kind of income generation or even a retirement plan. So an exchange traded fund is a basket of securities, stocks, bonds, commodities, or some combination of these that you can buy and sell through a broker. ETFs offer the best attributes of two popular assets. They have the diversification benefits of mutual funds while mimicking the ease with which stocks are traded. Now, the types of ETFs. Let's go over these. Market ETFs, designed to track a particular index like the S&P 500 or the NASDAQ. Then you have bond ETFs, designed to provide exposure to virtually every type of bond available. And that includes U.S. Treasury, corporate, municipal, international, high yield, and several more. Now, the sector and industry ETFs are just that, designed to provide exposure to a particular industry such as oil, pharmaceuticals, or high technology. Commodity ETFs, guess what? That's where you get your gold, oil, corn, and they track the price of that commodity. And then style ETFs, designed to track an investment or market capitalization focus such as a large cap value or small cap growth type. Now, the foreign market ETFs, designed to track non-US markets such as Japan's the Nikkei index or Hong Kong's Hang Seng index. Now, I don't know Chinese, but hopefully that's how you pronounce it. Inverse ETFs, designed to profit from a decline in the underlying market of an index or shorting. If you don't know what shorting is, it's basically selling the ETF or shorting the stock and then buying it back lower. So you sell high and then buy back lower. You often hear me talk about shorting call options or put options, and that's basically selling them and buying them back cheaper. So I write a higher contracted price for basically like insurance or premium, and then I buy it back cheaper, and that's my profit. I know there was a lot of questions saying, well, I don't understand this because you sold it high or the option was high and then it's lower and that's still a price, where most people think you buy low and sell high. It's the inverse of selling high and buying low. So actively managed ETFs, designed to outperform an index unlike most ETFs, which are designed to track an index. Exchange traded notes or ETNs. In essence, debt securities backed by the credit worthiness of the issuing bank, which were created to provide access to illiquid markets. They have the added benefit of generating virtually no short-term capital gains taxes. Alternative investment ETFs, innovative structures such as ETFs that allow investors to trade volatility, maybe options, right? Or gain exposure to a particular investment strategy such as currency carry or covered call writing. You hear a lot of that term that I talk about, covered call writing, where you own the asset and you're writing an option against it at a higher price. And if that price is met, you capture the premium, and then you also sell your stock, the difference between what you bought it for and you sold it for. And I always ensure that I talk about that break even. If we go out and buy a car for $4,000, if we're in the automotive industry, you want to sell that car for more than, guess what, $4,000. So that's your break even price plus insurance and all that, while you hold on to that asset. But for this case, you're writing a call option. For instance, if I buy XYZ stock at 50, I may write the covered call option at 55. The difference of 50 and 55 I make money off of, plus the premium that I take in where that other person bought the contract. So I'm writing that contract out taking premium in, while the buyer of that option contract is giving me that money and they're paying a debt to me. All right, so the next slide. ETFs can be bought and sold at current market prices at any time during the trading day, unlike mutual funds and unit investment trust, which can only be traded at the end of the trading day. Also, unlike mutual funds, since ETFs are publicly traded securities, investors can execute the same types of trades that they can with a stock, such as limit orders, which allow investors to specify the price points at which they are willing to trade, stop loss orders, margin buying, hedging strategies, and there is no minimum investment requirement. So let's back up to this limit orders. I tell you guys all the time, you can actually go in, set your computer, set your platform, such as the Thinkorswim platform, to buy a certain stock at a certain price that you want to pay for it, and vice versa, whatever you want to sell it for. Same thing with options, Forex, and all that. You put in the limit order. Don't ever, I'm not a financial advisor, but I would say don't ever put in a market order, because just because it shows, for instance, 24 at that stock price, you could actually pay 26, 27, depending on where the market wants to give you that stock at, or the market makers will write that security over to that seller, if that makes sense. So a market order, you can actually get assigned a stock or a price way above than what you're willing to pay for it for, and you just basically got screwed. So keep that in mind. Limit orders. Make sure you're always putting in your limit order for the price that you want to control. Because ETFs can be cheaply acquired, held, and disposed of, some investors buy and hold ETFs for asset allocation purposes, while other investors trade ETF shares frequently to hedge risk or implement market timing investment strategies. So when we're saying hedge risk, if I'm, and I don't want to get too much in detail about beta weighting and all that, your portfolio, but a beta weight of 0, it means it's equally balanced. So if one share goes down, you have another share that's probably going to go up, or the strategy of buy and selling, where you're buying options and you're selling options, and it kind of makes sure your portfolio is balanced, if that makes sense. I may buy a stock at $2, sell it for $4, and vice versa. I may sell a stock. This is just in a real quick visual theory, basically. And then I'm selling a stock for $4 and buying it back for $2. I'm basically balancing out my strategies to try to make sure when the market goes up, I'm making profit, and then when it goes down, I'm also making profit, if that makes sense. So, also unlike with mutual funds, options, including put options and call options, can be written or purchased on most ETFs. And we're going to take a look at that. I'm going to show you one of the most favorite ETFs that I like to use, and many investors do use this one, but I'll cover that in a second. Covered call strategies allow investors and traders to potentially increase their returns on their ETF purchases by collecting premiums, the proceeds of a call sale, or right on call options written against them. There are also ETFs that use the covered call strategy to reduce volatility and simplify the covered call process. Again, I always mention that covered call writing is one of the go-tos that I use, and obviously many investors do, and it's quite profitable. So the SEC generally requires ETFs to be transparent, and issuers generally are required to publish the composition of the ETF portfolios daily on their website. So we can think of this: an ETF is almost like a hedge fund that's publicly traded on the stock market. So instead of going and finding a hedge fund that you want, you can actually just go to the ETF itself on your platform and invest in it. And obviously there's the transparent controlling of the SEC, where they make sure that they have to be documenting their entries and exits and all the financials, their expense ratios and all that, to us as investors or traders. Now, however, the SEC does allow certain actively managed ETFs to be non-transparent. Example, they do not have to disclose exactly what they own. Okay, that doesn't necessarily mean that, for instance, the SPY, you don't know what they own, but they could potentially hide that or not disclose it. So always make sure you're doing your due diligence as an investor, an individual trader, and investor, doing your own due diligence on those to understand what they're actively in, because you don't want to. unfortunately, the stock market with today's COVID crisis is kind of up and down. Interest rates are low, so it could be a buying time, but it's also borderline of a crash, right? We understood this in 2008 when everything plummeted. So if an ETF is highly invested in real estate and you're thinking that the real estate market may come to a crash, guess what? You don't want to be in that ETF. So ETFs are priced continuously throughout the trading day and therefore have price transparency. So just like anything on the stock market, everything is always priced live data feeds. So ETFs are structured for tax efficiency, and keep this in mind. These are things you want to write down. ETFs are structured for tax efficiency and can be more attractive tax-wise than mutual funds, more so than mutual funds. Okay, keep that in mind. These are probably better off in the tax efficiency world or sector, or the term, more attractive than mutual funds. And a lot of your 401ks are based off mutual funds. So individual investors who control their own portfolios, their own retirement plans, portfolios, this may be something you want to look at, is ETFs and covered call writing. I'm not a financial advisor, but just look into that. Do your own due diligence. Unless the investment is sold, ETFs generally generate no capital gains taxes. Obviously, you don't pay capital gains taxes unless there's a written, signed, or what official document saying I sold that and now I have profit. You don't pay on taxes that unless you're in a different 401k where you pay your taxes ahead of time. Until you take profit on most things in the world, business, sales tax, etc., you don't pay taxes on that because they typically have low turnover of their portfolio securities. So that means most people do not get out of them. They stay in it. While this is an advantage they share with other index funds, their tax efficiency compared to mutual funds is further enhanced because ETFs do not have to sell securities to meet investor redemptions. Now, in the U.S., whenever a mutual fund realizes a capital gain that is not balanced by a realized loss, the mutual fund must distribute the capital gains to its shareholders, and the shareholders must pay capital gains taxes on the amount of the gain, unless such investment is held in an individual retirement account, even if the distribution is reinvested. So keep that in mind. Even if the distribution is reinvested, you're going to have to probably pay taxes on that individual retirement account. We all know that when you're investing in real estate, typically you don't pay capital gains taxes if you roll that over to the next investment or next home, whatever the case may be, similar to an ETF. Okay, so here's common ETFs. And this is one of the ones that I was talking about that I'm going to bring up that I like to invest in. Now, here's the list for you guys. Make sure you screenshot this, write this down, whatever the case may be. And then I'm going to go over to my platform and show you some of the possible returns that you can make. These are real numbers. This is not financial advising where I'm telling you to recommend this. This is the platform. This is an educational purpose type lesson. And what the system shows me is actually true numbers. So, the SPDR SP and 500 is what we call the SPDRs. SPY. This is one of the most probably popular ones that most investors use. The oldest surviving and most widely known ETF tracks the S&P 500 index. Now, what is the S&P 500 index? It's most of your top Fortune 500 companies or the biggest 500 companies on the stock market, such as Amazon, Google, Apple, Microsoft, etc. Now, I may be wrong on some of those, but for the most part, there are some big dogs in the SPY. Now, also another popular one, the Ishares Russell 2000, the IWM ticker, tracks the Russell 2000 small cap index. The Invesco QQQ, which is also popular, indexes the NASDAQ 100, which typically contains technology stocks. And then we have the SPDR Dow Jones Industrial Average. The DIA represents the 30 stocks of the Dow Jones Industrial Average. And then you have some sector ETFs, track individual industries such as the oil, OIH, energy, XLE, financial services, XLF, and then your real estate investment trusts, or the IYR, and biotech, BBH. And then some commodity ETFs represent the commodity market, such as crude oil, one of the biggest ones, USO, and natural gas, UNG. And then physically backed ETFs, the SPDR Gold Shares, GLD, and iShares Silver Trust SLV hold physical gold and silver bullion in the fund. All right, so this is a lot of information, guys. ETFs provide lower average cost since it would be expensive for an investor to buy all the stocks held in an ETF portfolio individually. Okay, let's back that up. ETFs provide lower average cost since it would be expensive for an investor to buy all the stocks held in that ETF portfolio. So it's almost like saying, okay, well, I don't want to go to Amazon, I don't want to go to Google, I don't want to go to Microsoft, I don't want to go to Apple, I don't want to go to Tesla and buy all of these myself. I'm going to invest in the ETF. Now I'm going to make money off the performance of all those funds in general or as a whole. So investors only need to execute one transaction to buy and one transaction to sell. So it makes it easier, which leads to fewer broker commissions since there are only a few trades being done by investors. Brokers typically charge a commission for each trade. So some brokers even offer no commission trading on certain low-cost ETFs, reducing costs for investors even further. An ETF's expense ratio is the cost to operate and manage the fund. ETFs typically have low expenses since they track an index. For example, if an ETF tracks the S&P 500 index, it might contain all 500 stocks from the S&P, making it a passively managed fund and less time intensive. However, not all ETFs track an index in a passive manner. I think I duplicated this one. I did. And now we're going to quickly go over the pros and cons. And then after that, I'm going to show you a couple returns or strategies that I use and hopefully teach you on how to do an ETF covered call writing. So there are a few pros and cons. As you can see, the access to many stocks across various industries, low expense ratios, and fewer broker commissions. Risk management through diversification, and then ETFs exist that focus on targeted industries. Now the cons are actively managed ETFs have higher fees. The single industry ETFs limit the diversification, and the lack of liquidity hinders the transaction. So it's almost like if the market starts crashing, then that lack of liquidity, all the market's going to crash anyways in that fund. And that's generally how the entire stock market is going to be. But to reduce those transactions, I'm going to show you basically the options and how to write those and then buy them back and set your limit orders. So we're going to try to basically cover how to defeat these cons. So let's go over to my system, the Thinkorswim platform. This is by TD Ameritrade, and I'm looking at the SPY. Now, in some of my other courses or lessons or even videos you may find, I talk about the covered call or the poor man's covered call. The poor man's covered call is instead of buying the call itself and then writing against it, or basically buying 100 shares of SPY at $341, which would set us back $34,000, we can sit here and go out 2 years, which is around 639 days, maybe 730. The more farther you get out, these options are going to be more pricey, and it's going to cost you more. So this June 17, 2022, I'm going to look at around a delta of either 80. We know that that's the prime because for every dollar that the SPY moves, we're going to lose 80 cents or gain 80 cents or theoretically $80 and lose $80. Because remember, 100 shares or one option contract is equivalent to 100. So you have to keep that in mind. So even at this delta 90, I can buy, in hindsight, the 200 SPY for $14,500, or what we see as 145. We have to times this by 100. There's no volume or no open interest. Volume is the amount of shares or transactions today. The open interest is how many positions are still left open. So we might have to back up to 548. There's starting to be some open interest. We may or may get into these positions determined by if there's an order that we get into that the other person wants out of. We can go to 856, and there's still no long-term moves or anything. So I'm kind of looking at this like there's not a lot of interest later on for the SPY. Okay, so then I want to go to charts and I want to go to news and find out why isn't there anything going on in the SPY. If I don't read anything, then I'm going to start looking at the internet, Google, and doing some investigation or research, figuring out why isn't the SPY invested in. Most people do have the SPY in their portfolio. So this tells me there could be a market concern or an economical concern here in the near future. We don't read the future. No one can go into the future and come back and say this is what's happening. But we kind of see this with COVID. U.S. indices are higher for the session as investors await today's Fed decision on monetary policy. Strong earnings from FedEx and a rebound in tech names also lifted market sentiment. Okay, so here's the thing. The Fed's decision of a monetary policy. We also know cryptocurrencies coming into play. So the market's kind of wondering what's going on. So here's why the SPY is probably not heavily invested in right now. Another resource that I use is the SPY, the Guru Focus. Then I take a look at the SPY. And those who know Guru Focus, I've taught this. I showed you this is one of my go-to resources. Is this tells us some of the biggest financial advisors and gurus and hedge fund managers of what they're doing. So we can see Ken Fisher reduced his amount on 6/30. Yacktman Asset Management reduced. Charles Brandis sold out. Mario Gabelli, however you pronounce that, he reduced his. Warren Buffett, he actually bought in December of 2019. George Soros reduced. George Soros sold out. So here's a couple of things. You know, money does move the markets, and we need to understand that. So here's a couple of things that I kind of see concerning. The SPY is not really a heavily invested fund right now. And I also wanted to show you Investopedia. Just go to Investopedia, type in ETF or Google ETF, and you're going to see how they create ETFs, creation when shares trade at premium, the redemption, and so on and so on. This whole course, or this lesson, was presented by, or sourced by Investopedia. I don't want to teach you guys something that I don't really know familiar with. Most of this stuff I do know, but just kind of get some more credibility behind this whole lesson. It is from Investopedia. So just take that into note. ETFs, okay? I'm going to try to find you some that are relevant, that you need to look into, but I'm also seeing this live that it's going to be hard to get into these. If I can get some volume in some of these dates, we can take a look at this. But this is kind of concerning. But I do want to show you an example of what I look at, and obviously it's open interest and volume, but I also never want to pay more for the option than if I was just to buy 100 shares of something, because the cheaper we can buy this off of, the goal is to go 30 to 45 days out and sell contracts on that and pay that thing off, or to break even on the difference of the strike prices, which is going to be, for instance, if I'm looking at this one, this $85 one, 85 SPY is too much. Too much is here. This is too much. You know, you're going to pay $25,000 for an 8,500 position. But if I need to be able to pay that off, and it's just not worth it. So the options premiums are pretty high on these. Still $20,000 for way more. Okay, now we're getting into some better numbers, and they're high because typically the SPY is not going to crash down to 100. The market's saying there's so many chances that you're not going to see 100, so you're going to obviously pay way more. But for a little bit more common sense and better strategy, we could pay delta of, I always look for delta 80 and see what that price is, and then see how far away it is from the current price. If it could potentially drop to that, then it's kind of concerning. I may go up to the next delta, which is 90. You know, I look at 80, 85, 90, because like I said, every point that SPY moves up, I'm going to earn $90 already automatically. So let's look at this 200. 200 to hold 100 shares at 200 would cost us $20,000. Well, this option to get into this is only $14,000. To find our break even, we take $20,000 plus $14,000. That's $34,400 and something, right? 14 plus 200, or we can do 144 plus 200 divided by 100 is a common equation. But look at this. This tells us our break even already. We go ahead and go into this, and it tells us break even stock price, 344. So we have to at least sell covered calls at the 344, because if it does go up to 344 and we have bought it at 200, that's going to cover the difference between those strike prices, if that makes sense. We're paying $14,000 for a 200 position. It goes up to 344. The market or the platform is going to assign us 100 shares at 200 and then sell them to the next person at 344. And that's where that break-even stock price comes from, because we paid $14,000, and then the system is going to give us that for at 200, the strike price at 200, and then sell for 344. So the break-even is at 344. So let's keep that in mind. I'm going to back up here to 30 days. We paid $14,000 for an option contract. We're going to look at 44 days. Make sure we get at least 344, which is up here in the delta 47. And then we're going to sell either at 344, 345 every 44 days. Brings us $800. Okay, so 800 divided by 14,400 is a 5%, 5.5% return. So I'm paying $14,000 for an asset, and then I'm writing contracts against it at 344, 345 for $800, and that gives me a 5% return. The quicker I can do this over and over again, guess what? I pay that $14,000 off. When we come to expiration out, what was this at? 548 days before March 18, 2022, 2 years from now, I want to be able to pay that 14 grand off to be able to own this for free. Because then once I own that for free, I can carry on and just keep writing options, whatever days, whatever strike price, as long as it's above that, obviously, for $1,400 in cash, $1,300 in cash, $1,318 in cash, plus the difference in the strike price. Because now that stock's free, and anything you write a contract for, you take that difference of 200, for instance, and the difference at this strike price, if it goes above there, and you just make that premium plus the difference in the strike prices. So these are ETFs. Let's look at USO, another example. This is the oil. I'm going to go 821. I'm going to see if there's any volume and any open interest that I could potentially get into. And I'm not really seeing anything. I mean, I'm looking at this 90 delta, but look how much I got to pay for it. It's almost pretty much what I could just buy it for. Best case, I could get in at 12, so I own a $1,600 position for $1,200, and then my break even is going to be 3065, right? 3065, because we take in what we have to pay for that added on top of the position of 100 shares, and that gives us 3065. Go up here to 30 days. Wow, it's way far out of the money, so it's not even worth doing. I mean, even at break, even way below the 16 at 4, it's not going to work out. Here we go. This is a weekly. Sorry, this is a weekly split, or not a weekly split. This is a weekly. You got to be careful of this. When you see these yellows, you can go into these, but this is giving us the price that the U.S. At $8.18. Got to watch out for that. Let's go in the normal options trading table. So at 30, I can get $51. Okay, $51 on a $1,500 investment. It's 3.3%. So every month I can make 3.3%, $50 off a $1,500 investment. Now, I don't know about you, but if I was to take this example and compare it with the real estate market, if I wanted to say I can go buy a $100,000, $200,000, $300,000 house, and I have to give down most of the time, unless you use a VA loan or something that you basically get a zero down payment. If you give up 10%, you're already giving up $10,000. Now take in expenses, take in your mortgage payment, take in insurances and all that. Are you going to make 3.3%? Are you going to make 5%? Are you going to make 10%? It's going to take $10,000 to make maybe 1%, 2%, 3%. Fix and flips, of course, a little bit different story. But those who are buying real estate, renting it out, flipping it long term, basically everything you take in consideration, and then you make your mortgage payment, it's really not worth it. I don't feel. I'm not a financial advisor. I'm not a real estate guru. This is what I'm just teaching. This is what I know. So, investingondemand.com, my YouTube channel, investingwithchris.com is some of the best platforms where I take all this knowledge and apply it to the website for you guys. I am passionate about this. I want to teach what I think is common sense and common financial education that the colleges, that you're not going to learn this anywhere else. You're going to have to self-educate yourself, and I'm bringing it to you. As they say, you don't know what you don't know. This is ETFs lesson. As always, subscribe to my YouTube channel. Check me out on investingwithchris.com, investingondemand.com. And until then, I'll see you next time.